The LinkedIn share price took a tumble recently as founders and insiders took the first opportunity they could to sell their shares. Cashing out for startup founders is not very easy post-IPO. One of the problems is that the SEC has some very strict insider trading regulations that prevent insiders trading shares based on information that's not in the public domain. And founders are often classified as insiders, so there are certain regulations on when and how insiders can trade their shares. There's also a lock-up agreement following the IPO that restricts the founders of the company from selling their shares for a period of time. And what happened here was that the founders, as soon as the lockup has been released on LinkedIn shares, some of the founders have decided to sell. And this has a reaction. The third problem with cashing out when you're a startup founder post-IPO is the reaction of the market, the investors and the other shareholders. What do they think if the CEO of the company is selling as soon as he possibly can? Is he deserting the sinking ship? This has an effect. And the effect in the case of LinkedIn was to force a 25% drop in the share price when the CEO, Jeff Weiner, announced that he was selling 372,000 shares as soon as the lockup was released. There was a stampede of investors to a certain extent, and about 25% was dropped from the capitalization, the value of the LinkedIn shares, following the announcement of Jeff Weiner's sale post the lockup release. Reid Hoffman, by the way, is the founder who holds many more shares than Jeff Weiner, is not selling. If he did, there may be an even bigger effect on the share price. So, founders of companies looking to cash out should weigh up the alternative of IPO versus a merger and acquisition sale. In a merger and acquisition, often the founders of the company can walk away post-merger with cash in their pocket, almost all their cash. There may be a withholding for escrow just in case some unforeseen expenses appear after the deal has been struck to sell the company, but generally they get to walk, if it's a cash deal, they get to walk away with the cash. Sometimes they can be left holding shares in the acquiring company, which they can subsequently sell on. But a trade sale can provide an immediate pile of cash, whereas cashing out post-IPO takes years and can be problematic, as LinkedIn and many of the new startup IPO companies are currently finding out.